Hi all, welcome to my channel Satish Vlogs. In this video, I would be explaining the concept of deferred tax asset. What is a deferred tax asset? What are the general entries for a deferred tax asset? How this deferred tax asset needs to be reported in financial statement? All these details I would be explaining in this video. Okay. With the description of the concept which is deferred tax asset, it is evident that this is related to the asset, which means this doesn't impact my income statement. This only gets reported in the balance sheet. Okay. Deferred means postponement, which means postponement of the tax asset to the future period. Okay. And this deferred tax asset primarily arises because of temporary differences which is being arised between book profits versus taxable profits. Okay. What is a book profit? What is a taxable profit? What are the temporary differences and the permanent differences? All these concepts I would be explaining in my future video, which would be posted in my channel soon. Okay. With this introduction, let's move to the next slide. Yeah. In this slide, there is a diagram which clearly depicts like a cycle, which is nothing but the accounting cycle. What is an accounting cycle? What are the various phases of an accounting cycle? All those details I have already shared in my previous video on accounting cycle. I request the viewers to go through that video before getting into the details of the current video on deferred tax asset in order to gain better understanding of the current concept. Okay? Yeah. I would be explaining the concept of deferred tax asset with an example of provision for bad debts. Okay? Okay. As part of the accounting cycle, my first phase is business transaction. Deferred tax asset is a business transaction. How this deferred tax asset arises? In my previous slide, I had clearly mentioned this deferred tax asset arises because of the temporary differences between book profits versus taxable profits. So to explain this concept, I would be considering provision for doubtful debts. Okay. Okay. I would be creating a provision for doubtful debts in my book profits of an amount of $100,000, which is allowable expense from accounting standpoint. However, from taxable perspective, the provision, the expenses won't be allowed on a provisional basis. It should be actually arised. So in taxable income, this provision of $100,000 would not be allowed as an expense. If it doesn't allow, then what happens? My taxable income would get overstated to the extent of $100,000 when compared with my book profits or accounting income, right? Yeah. The tax would get computed on the taxable income. So whatever the tax which has been arrived on the $100,000, we need to treat it as a deferred tax asset. Okay. So with this, it is clear that how the deferred tax asset arises. Now let's move to the next phase of the accounting cycle, which is a generalizing phase. See, for the business entity, whatever the tax expense which is being incurred, that needs to be paid out in terms of bank or cash. So for that reason, I would be crediting the bank account. Now I need to bifurcate the total tax amount between the tax expense and the deferred tax asset. How that needs to be done? As I had already mentioned in my previous first phase, the tax which has been computed on the excess or on the provision amount of $100,000 related to the provision, that amount needs to be considered as a deferred tax asset, right? So that amount would be categorized against a deferred tax asset, and the balance amount I would be considering as a tax expense. So this is clear, right? Now let's move to the third phase of an accounting cycle, which is a ledger postings phase. How this works? For whatever the journal entries which are being journalized as part of my second phase, for all those accounts, I would be creating the ledger accounts in my third phase of an accounting cycle. What are the accounts against which the journal entries were made in second phase? Income tax expense account, deferred tax asset account, and the bank account. So all these three accounts for which the ledger accounts are required to be created in the third phase, and the entries which were posted as part of generalizing are required to be posted in the respective ledger accounts. Okay, hope this is clear. Now let's move to the fourth phase of an accounting cycle, which is trial balance phase. What is a trial balance? Trial balance is nothing but the summary of all the balances of the ledger accounts, right? So in the ledger postings, we have opened, created three ledger accounts, right? Income tax expense account, deferred tax asset account, and the bank account. So the balances pertaining to these three accounts are supposed to be updated in the trial balance, right? Yeah. So the sum of the debit balances should match up with the sum of the balances which are shown under the credit side in the trial balance, because as we have been following double entry system of bookkeeping while making the journal entries, so ideally there shouldn't be any discrepancy in amounts between the debits and credits. The amount should match us up. Okay, hope this is clear. Now let's move to the last phase of an accounting cycle, which is financial statements. What are the financial statements? One is the income statement and the other one is the balance sheet, right? Initially, I had clearly said that this deferred tax asset would impact only the balance sheet, right? So the regular tax expense would be directly debited to income statement, and the deferred tax asset would get reported under asset sides in the balance sheet, and also there is one more account which is bank account would get reported under asset side of the balance sheet. So hope this is clear, right? If you guys really like my video, request you to like it, share it to your friends, and subscribe for more videos. Okay, thank you so much. Catch you in the next video.